Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Wednesday, 13th August. Coming up on the show, global markets rally after yesterday's US inflation report, with Meta set to hit a big milestone, while some popular stocks are nosediving today. Also, the US deficit soars, and we'll have the latest on the next crypto IPO about to hit the markets. So grab your coffee and let's own the morning. Let's kick off with the markets. We start in Asia. Stocks rallied here, led by tech stocks. The Nikkei in Japan rose for a sixth straight session, hitting yet another record high. Hong Kong's Hang Seng Tech Index, home to some of China's biggest tech firms, actually rose by more than 2% as well. The rally in tech wasn't just limited to China. South Korea's SK Hynix, Japan's Sony and Taiwan's TSMC were among the chip stocks leading the charge. And that tech charge has also spread to Europe. Note that the FTSE 100 in the UK is not up as much as the others. Why? Well, it has a smaller tech sector. The pound is also rallying, pushing above $1.35, near a three-week high. And what this all points to when the opening bell rings on Wall Street is another positive day for stocks, just a day after the S&P 500 and Nasdaq touched new records. Now, moving on to government finances. The US government's budget deficit grew nearly 20% to hit $291 billion in July. That's despite another record month when it came to inflows from tariffs. Some $27.7 billion in customs duties. That's $8 billion more than 1 year ago. Even as Trump talks about America becoming rich because of his import tax hikes, federal spending keeps outpacing the revenues collected by the government. That financial picture might change as companies exhaust their pre-tariff inventories, forcing them to import more goods and generate even more in tax revenues that could whittle away at the deficit without meaningfully reducing it as promised. And finally, that growing expectation that the Fed will cut rates next month is also helping to drive the markets higher. We saw stocks hit those record highs after the release of the July CPI report. Though the data showed inflation had ticked up, it increased by less than expected. The results boosted bets that the Fed would cut interest rates at its September policy meeting, especially in light of recent warning signs that the labour market is weakening. All this has also helped to boost demand for riskier assets. Well, Morgan Stanley's US chief economist, Michael Gapin, gave my colleague Ali Kanal his take on what he believes the Fed will do next in light of where we stand when it comes to inflation and the state of the labour market.
I think that the debate here really comes down to how much the Fed values the unemployment rate as the right summary statistic of the labour market, or how much it hangs its hat on softness in payroll. So I think most everyone on the committee would say, yeah, inflation's further from our 2% target than the labour market is right now. But if payroll growth is slowing, maybe we should do some risk management here. In our view, we would say there's enough inflation momentum here that suggests inflation will continue to deviate from the Fed's mandate. But look, we're basically down to one employment report and one other inflation report that the Fed will receive during blackout. So they may just take comfort from the signal and cut in September. But in our view, immigration controls are likely to keep the unemployment rate low, and that means a tight labor market. And that's why we think the Fed should or will remain on the sideline for the rest of the year.
Okay, time for market movers, and we're going to the world of crypto. So in the last few hours, we've just found out that Bullish, a cryptocurrency exchange operator, has priced its US initial public offering above its indicated range at $37 per share. The offering raised $1.11 billion for Bullish based on 30 million shares sold and valued the company at $5.41 billion. Bullish was earlier aiming to price its offering between $32 and $33 per share. Now, it's worth noting that Bullish counts billionaire Peter Thiel amongst its backers. Well, the share sale comes as IPOs are bouncing back following a dry spell for US equity capital markets that lasted for more than 2 years. With its listing, Bullish joins a burgeoning list of crypto players that have tapped public markets this year, buoyed mainly by crypto-friendly regulations under the Trump administration. In July, US President Donald Trump signed a law to create a regulatory regime for dollar-pegged cryptocurrencies known as stablecoins, marking a huge win for crypto supporters who have long lobbied for such a regulatory framework in a bid to gain greater legitimacy for an industry that began in 2009 as a digital Wild West, famed for its innovation and speculative chaos. Now, Bullish, which is led by former New York Stock Exchange President Tom Farley, operates an exchange that offers spot crypto trading, futures and derivatives trading, and also owns media outlet CoinDesk. Institutional investors include BlackRock and Cathie Wood's ARK Investment Management, and they've committed to buy up to $200 million worth of shares from Bullish's offering. It's expected to start trading on the New York Stock Exchange under the ticker symbol BLSH today. Now, another thing to keep an eye on in the world of crypto today is Ether. Why? Well, Standard Chartered has just raised its year-end target for Ether to $7,500 from $4,000. It said that there's been an improvement in industry engagement in recent months and also pointed to the emergence of Ethereum treasury companies. Okay, coming up, we'll be sticking with the world of crypto. We've got an interview with the CEO of Circle, Jeremy Allaire. Stick with us here on Market Sunrise. Welcome back, and as promised, we'll have more insights about crypto today. Circle, the stablecoin issuer, reported strong second quarter earnings yesterday. It was its first earnings report since its IPO. Shares have been up a lot since the company went public, even though they are losing some ground in pre-market this morning. So what's next for Circle, and how is it expanding its offering to continue to keep up with investors' expectations? Well, Circle co-founder and CEO Jeremy Allaire spoke with our very own Julie Hyman.
So you guys have seen huge increases in issuance, in circulation, in transactions using USDC. Can you tell me a little bit about what has driven this? How is it being used, and who is using it?
Yeah, I mean, we really, from really over a year ago, have seen this kind of very, very steady rise in supply of USDC. We've grown faster than any other major stablecoin, as you noted, 90% year on year, and year to date, sitting on August 10th, over 65 billion in circulation, which is about 49% year to date growth. So we're seeing that strong growth, and we've seen that growth actually accelerate in even the most recent weeks. And I think there are a number of things happening. I think one is just overall activity globally in the digital asset economy has been growing. I think a second, and we've talked about this a lot, is we're continuing to see growth in the use of dollar digital currencies like USDC as a store of value around the world in cross-border settlements, whether that's between people or businesses in emerging markets. And we're seeing more and more use cases in traditional payments networks and in capital markets use cases. So use cases continue to expand. And I think people are finding that this is an incredibly high utility new form of money, which, as you know, also this quarter was solidified by really being enshrined in federal law through the passage of the Genius Act. And so I think a lot of these things are contributing to the interest and the demand. And then obviously on a go-forward basis, the number of mainstream financial institutions, technology companies, large corporations that want to use this infrastructure is really growing, and we're seeing that demand coming in.
So it sounds like the shorter answer is everywhere and from everyone in some ways, Jeremy. I am curious if you can tell me more about those cross-border transactions, how it's being used in emerging markets. Do you have an idea of sort of the percentage of transactions that are being done overseas versus in the US, for example?
Well, we believe, and we have very good data, that a material majority of transactions are non-US. There's actually a lot of activity out of Europe, but there's also significant activity in emerging and developing markets ranging from Latin America to Africa to Middle East to Southeast Asia. and sort of the Asia market as a whole is a significant one. And while we don't sort of see every transaction in terms of the counterparties, what we do see are sort of trends in flows. And so you're seeing flows that are through, really powerful corridors, whether it's Latin America to Asia, suppliers and buyers, Middle East and Africa, which again is common kind of corridors in economic activity. So we see that, and it's one of the reasons why we built Circle Payments Network and launched CPN in Q2, is building a sort of application layer that financial institutions can use to more efficiently do international money movement and cross-border settlements using stablecoins as the settlement mechanism. And we went live with 4 corridors during the quarter: Hong Kong, Nigeria, Brazil, and Mexico. And through the remainder of the year, we're going to keep adding more and more corridors that allow financial institutions to take advantage of the speed, the efficiency, and the programmability of moving money on these networks.
And it will be interesting to see whether Circle can monetize some of those use cases described by the CEO. Now, we'll take another short break. We'll be back with trending tickers, and you'll see there's a lot to unpack this morning. Welcome back. Well, let's dive straight into our trending tickers. Well, we're seeing some big moves, particularly in tech, with some clear winners and losers today. We start with rising stocks. Number 1, Meta, which is inching closer to joining Nvidia, Microsoft, Apple and Amazon in the exclusive club of $2 trillion companies. Meta's trading just above $791 there, as you can say, in the pre-market, up around 0.1% after closing over 3% higher yesterday. Its valuation is hovering around $1.98 trillion. So what's pushing up Meta stock 2 weeks after strong earnings reports? Well, one reason, the head of Instagram, Adam Mosseri, said yesterday that its Threads platform had recently reached more than 400 million monthly active users. Also note that analysts at JP Morgan reiterated an overweight or buy rating for Meta, justified by strong growth and promising results driven by its new tools in artificial intelligence and targeting. Meta plans to spend up to as much as $100 billion in capex next year. Okay, next up we have the Singaporean e-commerce and fintech giant Sea. Now let's check the stock price. It's still in the green this morning, continuing its rally after it closed up 19% yesterday following standout second quarter earnings and strong sales growth. This reflects renewed investor confidence in Sea's e-commerce and fintech operations across Southeast Asia. And finally, let's move on to 2 stocks that are deep in the red this morning. First up, we have CoreWeave. The Nvidia-backed company slid more than 10% in pre-market. The AI infrastructure provider beat revenue expectations, posting $1.21 billion above estimates of $1.08 billion, but missed on bottom line with a larger than anticipated net loss. Now, as you can see here, CoreWeave has been skyrocketing in recent months. So what's behind this pullback despite solid top-line growth and a backlog of $30 billion? Investors are jittery about its steep expenses. Operating costs surged to $1.19 billion from just under $400 million a year earlier. And one more ticker you need to watch is Carver Group. The Mediterranean fast casual restaurant chain is under heavy pressure today. Well, let's check the price. Carver is trading around $64 in the pre-market, down nearly 24% after the company cut its full-year same-store sales outlook. Well, here's what's driving the move. Late yesterday, Carver reported Q2 results that came in softer than expected. Same-store sales grew just 2.1%, and management now expects lower growth for the full year, well below earlier forecasts. While CEO Brett Schulman told analysts that consumers are navigating a fog in the current economic environment. The company is still expanding. It plans to open around 60 restaurants in total this year, but investors are clearly worried that it might be losing momentum. And we'll be bringing more news about Carver later today, as we'll be joined by the CEO, Brett Schulman. Stay tuned for that interview later this morning here on Yahoo Finance. Now, moving on to another company that's just posted earnings and investors liked what they saw. On Running, the Swiss premium sneaker maker, saw its stock jump after posting a 32% sales growth and raised its outlook. CEO Martin Hoffmann spoke with Yahoo Finance's Julie Hyman.
Our industry has always been exposed to tariffs in the US. This is nothing new for us. Ever since ON exists, we have been paying around 20% of most of our imports. And now this number goes up to 40% for importations from Vietnam and 39% for Indonesia. So of course it's something that we don't like, but we are a premium brand, we are a fast-growing brand. And with that, we have so many opportunities to mitigate that impact that this allows us to increase our margin outlook. It allows us to be very confident that also in the long term, that 60% plus gross profit margin that we laid out 2 years ago is still what we believe in and what we believe we can achieve. And so it becomes part of our business now, having those tariffs. And I think in times like this, it's super important to focus on what you stand for. And we are a premium brand and we want to be the most premium global sportswear brand. We keep on investing in quality, in our innovation, in our customer experiences, in sustainability, in social impact. Those are non-negotiables. And besides that, we have not yet spoken to our factories. We have not yet spoken to retailers because we didn't need to. And the same is for price increases. We don't need additional price increases this year to mitigate the impact. We have done the increase in July, but there's so much momentum across basically cost of goods sold.
Martin, Julie again, have you gotten so those price increases that you instituted, you're not going to do any more you're not planning any more price increases this year. What has been the reception of retailers and customers to those price increases? Have you seen any kind of shift in what they're buying, in terms of cost sensitivity at all?
Obviously, it's early, just after 5 weeks, but July was actually the strongest month in the history of the company. So from that perspective, we don't see much. We also see that our order book remained very stable, and customer and our retail partners haven't changed that. And again, for us, the pricing is based on our premium position. It's rationalized because of the innovation and the products that we bring to the market, but it's also a strategic position where we want to be. We want to be perceived as the most premium brand, and pricing is part of that. It's not the result of the tariffs.
Okay, we've got some breaking news now. Okay, the international restaurant company Brinker has just released its earnings, and they've looked pretty good. In fact, they had beat expectations across the board. Now, adjusted earnings per share came in at $2.49. That was better than the $2.46 that the street was calling for. Revenues came in at $1.46 billion. That's better than expectations of $1.44 billion. Now, remember, Brinker owns the chain Chili's. It owns around 1,600 restaurants. In fact, sales at Chili's rose by 24%. So across the board, really good results. And as you can see in the pre-market, shares up around 6.5%. They actually did fall initially after the results were released, but they've now gone in the right direction as far as Brinker investors are concerned. And the restaurant train, much better results than expected, as I said, and looking to improve their full year forecast as well. So good news there from Brinker, the restaurant chain. Okay, well, let's take a look at oil now. And as you can see, prices are down today after the IEA noted supply overtaking demand this year. Remember, investors are also waiting to hear about the outcome of Friday's crucial meeting between US President Donald Trump and Russian President Vladimir Putin. Oil traders are tracking preparations for the talks, given that they may result in an easing of US sanctions on OPEC Plus member Russia that could increase supply too. So what does this all mean for the energy sector? Well, Rebecca Babin, CIBC Private Wealth Senior Energy Trader, gave her take to my colleague Ali Kanal.
So that's a great question, Ellie. And I would say most of this pullback in gasoline prices has not been seasonal. Seasonally, they adjust those numbers in the CPI. This has been much more structural. And the structural change that's taken place for gasoline has really been the drop in crude oil prices. If we look at a year over year basis, crude oil is down 15%. Gasoline prices year over year are down around 9. So basically, the inputs or the crude that goes into the refiners to make gasoline has really been under pressure because OPEC has been bringing back a lot of supply over the last 6 months and really compressing crude prices lower, combined with the fact that the economy is in question as we kind of move along this tariff journey and understanding what's happening with demand. So we have this kind of increase in supply coming from crude oil and concerns about demand. So we've had a really big kind of pressure on the commodity price. Refining margins, interestingly, have actually held up really well. Thus, the 9% drop in gasoline versus 15% in crude. And that's actually because we have had product inventories in gasoline really low. Venezuelan products have been off the market. We had wildfires in Canada, which hurt some products. So the product market and the refining margins have been okay. All of that kind of compression in price has come from crude oil itself falling lower.
Interesting. So given all those structural changes, where do you see crude heading towards year end? Are prices skewed to the downside?
So the market is very much in consensus that the risk is to the downside from here. And it kind of plays into everything I kind of touched on. More supply coming from OPEC, more supply coming from non-OPEC. The EIA just released their monthly report and increased the non-OPEC supply for the year from the US, from Brazil. And then you have the OPEC supply as well. And demand, which is expected to kind of taper off here in the second half as tariffs start to bite. So consensus is that we gravitate down to kind of the mid to high 50s in WTI for the end of the year. My view is I actually think that's a little bit too negative and very much kind of telegraphed at this point. So I think we could kind of stay in this, let's call it 60 to 75 range, 60 being kind of that downside, lower end of the risk kind of spectrum, just because I'm looking at positioning, I'm looking at how many CTAs and systematic funds are starting to lean very short. The options market is starting to show you that puts are getting much more expensive than call options, which tells you that people are actively hedging that downside. So a little bit of it is starting to get priced in. So that's kind of, I like this 60 to 75 range. And I think the upside is bound by the fact that we do have a lot of supply that kind of sits on the sidelines in Saudi Arabia, in the UAE, that kind of buffers a potential supply shock. Now, if we lose, Russian barrels, and Friday is obviously a huge event for the oil market in terms of what happens with the Putin-Trump meeting, and if Trump decides to move forward with either sanctions on the shadow fleet or tariffs, that could change the picture pretty dramatically. I think the upside is buffered by that spare capacity.
That's it for Market Sunrise. Don't forget to look out for those Cisco results after the closing bell. I'm Ramzan Karamali. Go own the morning.